Natural gas rallied sharply last week, climbing more than 8% to close at $2.99 as traders reacted to a clear technical reversal pattern and a second consecutive bullish EIA storage surprise. While the price action signals the potential for a counter-trend rally, the broader backdrop remains bearish, with weak demand and robust supply continuing to cap upside momentum. Much of the drawdown, however, was less about genuine demand strength and more the result of weaker wind generation, raising questions about how durable this price momentum really is once temporary factors fade. Moreover, the outlook for the next two storage reports leans clearly bearish, which casts serious doubt on the sustainability of this rebound. The only real spark behind the latest surge was a bullish storage surprise, and once that catalyst is stripped away, the market is left with little more than momentum and speculation to stand on. Dry gas production stayed elevated, averaging above 107 billion cubic feet per day and registering year-over-year growth in the 6% range through the week. At the same time, U.S. demand slipped to 72.4 billion cubic feet per day, a decline of more than 15% compared to last year. Power burn has also underperformed, as mild late summer weather across key regions such as the Midwest and Northeast reduced cooling demand. On the export side, LNG flows hovered around 15.5 billion cubic feet per day, lending some support but falling short of counterbalancing the domestic oversupply. European natural gas futures slid over 5% in the final week of August to settle at €31, pressured by weak demand that allowed storage injections to outpace reduced Norwegian output from maintenance. Storage levels across the EU now sit at 77% of capacity, compared with 92% at this time last year. Muted Asian demand, particularly from China, has diverted LNG cargoes toward Europe, helping cushion the market against Norwegian supply cuts. At the same time, Russia has been shipping LNG to China from its sanctioned Arctic LNG 2 project, potentially curbing Chinese demand for spot LNG elsewhere. Geopolitical risks remain a key backdrop. The U.S. announced a 50% tariff on Indian imports tied to Russian oil purchases. Adding to tensions, President Trump warned of very big consequences if Russia resists peace talks, though a Zelensky-Putin meeting remains improbable. Overall, European gas prices closed August nearly 10% lower. On the weekly chart, natural gas has carved out a potential bullish closing price reversal bottom, suggesting that buyers are starting to gain the upper hand at current levels. A breakout above $3 would confirm the pattern and open the door to a 2 to 3 week counter-trend rally. The initial upside objective sits at $3.20, and if that barrier is cleared decisively, backed by a catalyst such as a sharper storage draw or a weather-driven demand boost, momentum could extend toward $3.40. That said, a retreat below $2.80 would invalidate the setup and re-expose the long-term floor at $2.64. Until the $3 threshold is convincingly breached, the broader downtrend continues to define the market's bias. Don't forget to comment, watch the previous video, and show some love for the channel. See you next time.